Hello, in this presentation we're going to look at capital investments and tools for making long-term capital investment type decisions, including the payback period, the accounting rate of return, and net present value. At the end of this, we will be able to list tools used to make long-term capital decisions, calculate the payback period, calculate the accounting rate of return, and calculate the net present value. So before we go into the actual calculations, just want to point out that two of these, the payback period and the accounting rate of return, are going to be quicker type calculations. So if we're thinking about a long-term project, I would call it like a back of the envelope calculation, although this is kind of like the front of the envelope here, but you get the idea. It's kind of a quicker calculation that's not going to be as intensive, that we can do fairly quickly and then make some preliminary decisions on that. And then we might go to a more complex decision, such as the net present value type of calculation. Net present value being more complicated because it does take into account the time value of money, which is going to be an important factor when we look into these. Now, when we think about capital investment decisions, we're usually thinking about longer-term investments, and because they are longer-term investments, we often want to put more time into them. We're going to have more money on the line. We're going to have more uncertainty out into the future. If we're investing like 10 years out or 20 years out, then we obviously have some uncertainty as to what's going to happen in the future. Therefore, we want to analyze that a bit more in depth. So that's the types of calculations that we will look at here. We're going to start off with the more back of the envelope type of calculation, and in order to do that, we're going to need to get the cash flow here. So our data is going to be on the left hand side, and we have project A, project B. These are the two projects that we are considering. Project A and B have the same investment, the $340,000. It's going to be a new machine. So the new machine for project A is a 5-year machine. And for project B, it's for 4 years. So it's a 5-year investment versus a 4-year investment. And then we have the cash, the income and expenses related to the two projects, being the sales of the 365 for A and 292,000 for B. Expenses being direct materials, direct labor. We have the overhead with depreciation included. We have the selling and admin expenses for a total expenses of the 311,560. So if we subtract those two out, we have the net income for project A of 53,440, and for project B we have the 34,752. So that's our data. So first of all, for the payback period, we want to know not the net income, but the cash flow. So when we think about these capital investments, oftentimes the question that we'll have is, well, when are we going to get our cash investment back? So we want to think about cash flow, not necessarily the net income. And there's one thing in this calculation that is income related. So we're going to take the net income, which is the 53,440 and the 34,752. We're going to pull out the non-cash depreciation. So within this overhead calculation, we have depreciation in there. Now, we didn't break it out in the data here, so we're going to assume it's straight line, and therefore we're going to have the equipment cost of the 340,000 divided by the number of years, the life, which is 5 for project A and 4 for project B. If we divide that out, then we're going to say that the annual depreciation for project A, 68,000, annual depreciation project B, 85,000. These are going to be included in the expenses here within overhead, reducing net income. However, they are not cash related. Therefore, if we just want to think about the cash flows for the payback period calculation, we need to pull that out. So we're going to say the expected net cash flow per year is going to be the net income, but we're going to add back in that 68,000 for project A, giving us the 121,440 cash flow annually. For project B, we have the 34,752 net income, adding back in the depreciation because it's a non-cash item, so we get the 119,752. Now we're going to use this information, the cash flow, the annual cash flow, to do our quick back of the envelope calculation for the payback period. So the payback period will just be the cost of the investment, in this case $340,000, both jobs, project A and project B. And then we're going to say the annual net cash flow, what we're going to get in terms of cash annually, being what we just calculated at the 121,440 for project A and the 119,752 for project B. And if we just divide that out, we're going to say project A will pay for itself in 2.8 years, and project B will pay for itself in 2.84 years. So you can see once we have the cash flow, this is a pretty quick calculation. And it's one of those calculations that gives good information, but it's not all that inclusive at the same time. We can say if we were to be pitching these two projects, we could say, well, yeah, it's a 5-year project, a 4-year project. It'll pay for itself. We'll get our return on the cash within 3 years, right? In 2.8 and 2.84 years in these particular projects. So obviously we would generally want to get the cash faster. That doesn't necessarily mean it's a better project or not, depending on, because there are other factors in terms of what's going to be the return on the cash. And that's what's not included here. But given just this calculation, of course, we would rather get our money back sooner than later. And that's kind of like the worst case scenario, what we're calculating here. It's like, well, we'll put the investment down. It's a lot of money. It's $340,000. We should have the return of that investment within the 3-year time frame. What does it not give to us? It doesn't give to us what the net income is, because that's obviously why we're investing the $340,000. We want to know what the return is. We're not doing it to get our money back. We're doing it to make money. So it's good. The safe thing is that we're getting the money back within this time period, but how much are we going to earn from this investment? That's what we want to get. So everything after that 2.8 and 2.84 will be revenue. Everything up to that is basically recovering the initial investment. The other thing it doesn't take into consideration is time value of money. So we have two different lengths of job here, 5 years and 4 years, and different payoffs here. So the question is, the time value of money becomes a factor when we're thinking into the future as well. So we're going to do our other quick kind of calculation. So, and once we do these, we'll go into the more in-depth calculation. This one being the accounting rate of return. Similar type of calculation, but this time we're going to take the net income rather than the cash flows. So accounting rate of return, we got the net income. That's the 54,440 here, and for project B, the 34,752. And we're gonna divide the annual average investment, divide by the annual average investment. So in order to do that, we're gonna take the investment, 340,000. That's how much we're putting in, and we're gonna divide. In this case, we're gonna divide by 2. Now, why are we gonna divide by 2? Because we're basically saying what's the annual investment or the average throughout the life of the project. So if we had the machinery, we would say we invested the 340. If in day 1 it was worth 340,000, after 5 years we're assuming it's worth 0 if there's no salvage value, and after 4 years in the case of project B, it's worth 0. So if we take the average, then would be the 340,000 at the beginning plus what's worth at the end, which we're assuming is 0, and then adding those up, which is just 340,000, and then dividing by 2. That would be the average. So we're taking the average over the entire life. Now notice that's a kind of a big assumption, because we could, that's assuming kind of like a straight line method. If we were assuming some double declining method, we think that it should be accelerated in the depreciation, that we can have a more complex kind of calculation in determining the annual average investment. But again, this is kind of like a back of the envelope calculation. So we might do more of a quick calculation here, and then if we decide to move forward, we'll probably go to the net present value type calculation, where we'll take into account more detail, including time value of money. So we're going to divide by 2 to get the average. We got the annual average investment, then being the 340,000 divided by 2 for the 170,000, and the 340,000 divided by 2 for the 170,000 for project A and B. And again, this is 170 over the 5-year period, starting at 340 and ending at 0, and then this is the 170 for the 4-year period, starting at 340 and ending at 0. Okay, so then we're going to get the accounting rate of return, which is going to be the 53,440 divided by the 170,000 for 31.4, and obviously we made it a percent there, so 31.4. And then we're going to take the 34,752 divided by the 170,000. We get the 20.4%. So this rate of return, if we're comparing two projects, what we're looking for is a higher accounting rate of return. That would be an indication of it being better. So project A has a higher accounting rate of return than project B, and so that would be favorable there. Again, good quick kind of calculation, easy to do, but doesn't give us the time value of money in there as well. So we probably want to go further and calculate something like the net present value, which we'll do at this time. So net present value, we're going to say that the value at 7% discount rate for project A and B. So first we need to consider what the discount rate is. What are we doing? we're going to take the time value of money into consideration. So notice we have cash flows 5 years into the future. If we get this 53,440 5 years later, it's not worth the same as it is today. So what we want to do is take that 53,440 and pull it back into today's measuring group, today's value. And the way we do that is we got to use some kind of interest rate, and we're going to call it a discount rate, that we're going to assume that the value will be discounted at. Why is it discounted? One, the value of money just goes down because of inflation. And two, it's the opportunity cost that we could be putting this money in. If we had it today, then we could be investing it and getting some rate of return. So whatever that rate of return is, we're assuming 7%, then we would have to clear that rate of return in order for it to make sense to have the investment. So we're basically setting the 7% kind of as the bar. And that means that if project A or B has a positive net present value at the discount rate of 7%, that means that we're getting a return higher than 7%. So let's see how this works. We're going to take the present value of cash flows. We're going to take the expected net cash flow per year. That's the 121,440. And we calculated that earlier, the expected net cash flows, and the 119,752. And remember, we did that by taking the net income and then pulling out the non-cash depreciation to get the cash flows, not the net income. All right, and then we've got the present value factor. So we're going to have to multiply times the present value factor. Where are we going to get that? Well, we could use a formula, or we could use tables. It's pretty easy to use the tables. We're going to use the tables in this case. If you do use tables, then when you look up the tables, you can look them up in various different places, but just make sure you're looking up the right table. So the common tables that you will see when you look up present value type of things, you'll see present value of 1, and that means that for our example, the discount rate of 7%, if we were looking for 5 years out of just one number, then we'd have to multiply it times this decimal here and get that number. In our case, we could do that for each year for like 4 years in the first one and 5 years in the second, or 5 years in the first one, 4 years in the second. But we'd rather do it in an annuity because our payments are all the same right now. So instead of doing 5 different calculations, we can do it a bit more simplified. So that's an option for us. We're not going to use that one. The future value, you'll often see, what that means is you're calculating our present day numbers to the future. And we're trying to get something to match apples with apples or kind of thing, but usually we're going to pull the future number back to ours. So the payment we're going to get 5 years out, we want to pull that back in today's dollars. We don't want to pull today's dollars up into the future normally. And then you're going to see the one that we're going to use is the present value of an annuity. And because the cash flows are all the same in this particular problem, we can then go to 7% and go to the 4 or 5 in terms of the annuity, which we'll take a look at next time in the next slide. And then the future value of an annuity, again, that would be the future value rather than the present. Not usually going to use the future value most of the time. So here's the one we're going to use. We're going to use the present value of an annuity of 1. And remember what we need to know. We need to know we're at 7, and we needed to know the 2 jobs. I think it was, what was it? It was 4 and 5. So the first one was 4. So we're going to multiply it times the first one. Well, the one that has 5 years, we're going to multiply it times 4.1. So note that if we took the cash flow and we said we're going to have an even cash flow over 5 years, you would think we would just take that cash flow and multiply times 5. And that would be the cash flow over the 5 years. But if we discount it, we're gonna have to multiply it times something less than 5. That's what we're looking at the table for. So this 4.1 is less than 5 years because we have to value it at something less. So if we had the same cash flow that we were gonna get every year for 4 years, you would think we just take that money times 4, and that would give us, the cash flow. But the present value cash flow needs to be multiplied times something less than 4, in this case 3.3872, in order to discount it for the 7%. All right, so we're going to take those numbers. That's where the 4.1002 and the 3.3872, and that'll give us the present value of cash inflows. So we're going to multiply that out. So we multiply the 121,440 times the 4.1002 to get the 497,928. And the same for project B. And then we're going to take that and compare it to the present value of cash outflows. And we don't need to do anything special with that. That's just the 340 that we spent at the beginning. Why is it just a 340 and we don't need to do something special? Because we did that at the beginning of the job. So obviously it's at that point in time. We don't need to pull it back. It's not like we got it in the future. If we did have cash outflows that went out through the project, then we'd have to do the same kind of thing. We'd have to look up the outflows and say, what's the present value of the outflows? But in this case, we put everything down that's going out in day one, which is typical for many projects. We bought the equipment today. We're going to get the benefits from the equipment in the future. And if we compare those two out, if we subtract those two, we're going to get the net present value of the 157,928 and the 624. So we can see that obviously project A is going to be higher in this term as well. Do want to point out though that the net present value could be used in two ways. That hurdle can be used basically to say if we want to accept any project, and it could also be used as a comparison between the two projects as it can be in this case as well. So if we could have a scenario where we would say anything that has a return over 7% is something that we would want to accept. Or we might have two projects and we have a limited number of cash to put in, and we would want to take the one with the higher net present value. Note that when we think about the net present value, anything that was positive means that we got a return of 7%. So if we were talking about one project and we're saying, hey, we only want to invest in something if we're going to get a 7% return or higher, then if we did this calculation, even if it just came to $1 on the net present value here, that would mean that we got a return of 7%. That's what this factor is saying. That would mean we got a return of 7%. This means we got a return of 7% and something extra here. Now, note that something extra can be compared between project A and project B, but we don't know exactly what the return is. We know the return was greater than 7%. And so in order for us to kind of figure out what exactly the rate of return was, we could kind of estimate, we could bump up the rate of return to 8% and whatnot and get this as close to zero as we wanted, or we can use some other methods in order to actually try to figure out what that actual rate of return is. That's going to be the internal rate of return.